Hello, guys! So today we are going to talk about a really important topic which will also be interesting. So what do you think it is? No idea? Yes, we are going to talk about something which is in more conversations recently, and that is the Gamestop short squeeze. So what is this so-called short squeeze? Hang out. I'll be discussing what short squeeze is in many different points throughout the video. But before we get into it, do me a favor and smash that like button, subscribe to the channel, and hit the bell button for notifications whenever a new video is published. And let's get started. So basically the first question that comes to your mind is what this short squeeze is and what is GameStop? GameStop Corporation is an American video game, consumer electronics, and gaming merchandise retailer. The company's headquarters are in Grapevine, Texas, United States. GameStop is the largest video game retailer, having over 5,000 retail stores operating under it in the United States, Canada, Australia, New Zealand, and Europe. GameStop, EB Games, ThinkGeek, and Micromania Zing are brands that primarily operate the retail stores under the company. Now let's talk about what a short squeeze is. A short squeeze occurs when a stock or other asset jumps sharply higher, forcing traders who had bet that its price would fall to buy it in order to forestall even greater losses. So this is what happened in the GameStop short squeeze. The two main billionaire hedge funds in this story are Melvin Capital and Citron Research. In the GameStop short squeeze, Melvin, Citron, and the rest of the others shorted GameStop stocks. Let's get to a quick review about Melvin and Citron. Melvin Capital Management LP is an American investment management firm based in New York City. Melvin Capital invests primarily in tech and consumer stocks, and as of January 2021, it is reported to have $8 billion under management. However, they had to suffer a lot after undergoing a loss of 53% during the GameStop short squeeze. Let's switch gears to Citron Research. Citron Research is an online investment newsletter that provides short-focused stock market commentary. It has published reports covering a range of companies based in the United States and China. Andrew Left is the founder and executive editor of Citron Research. However, it is one of the main companies that had to suffer due to the short squeeze of GameStop. This happened when Melvin and Citron immediately sold their shares of GameStop, which they had borrowed previously, putting up a margin requirement, and then waited for GameStop stock prices to drop. The crew of the Wall Street Bets said once, "If we all start buying tons of GameStop stock, we'll drive the price way up. The billionaires will pay tons of margin calls, and then they will have to repurchase the stocks probably from us at huge prices. We'll make money, and the billionaires will lose money." And that's exactly what happened. So if we are to break it down furthermore, GameStop company, after hitting an all-time low of $2.80 per share in April 2020, again, GameStop closed at $65 and shot up to 51% that same day. It even hit a high of $76 during the day, getting the stock halted several times due to it moving so quickly. So why do you think all this happened? Well, GameStop had over 138% of its float shares sold short, making it the most shorted stock in the United States stock market. Let's break that down further. Float shares are the number of shares available for trading of a particular stock. So over 100% of these shares are sold short. So what does that mean? It basically means Wall Street hates this particular stock and expects its value to fall. The way that it works is that they would borrow the stock, sell it, and then buy it back after the stock value has fallen. The price difference between what they sell it for and what they buy it back for is their profit. So essentially, if they sell GameStop at $20 and then the stock price falls to $5, they just profit at $15. So if someone thinks the company is overvalued, they can make money when that stock price falls in value. Now, the thing with short selling is that there is theoretically infinite risk since there is no ceiling on how high a stock price can go. So let's say that GameStop stock went up to $200, and the short seller who sold the stock for $20 now has to buy it back at that price. So simply, they just lost $180 per share, and that is why investing in stocks can be risky. And what if GameStop went to $1,000? Then they will lose $980 per share. So in theory, there are infinite losses with short selling. So the other thing you may be questioning is, how can they short more shares than there are shares available? Well, let's scale things down. And for example, let's say GameStop issued 300 shares of their stock. A fund wants to short the stocks. So they borrow 200 shares and then they sell them to a certain company. And this company does stock lending, and someone else comes along and they also want to short GameStop. So the company lends them the 200 shares and they go out and sell them. This means that there are 400 shares now sold short out of only 300 shares available. Now, I guess that was a bit complicated, but I brought it up just to show you guys how it works. It can be an endless cycle of borrowing and selling. But the thing is, short sellers have to pay interest when they borrow these shares, so it costs them a lot of money to hold this position. So that means if a stock goes up when they are expected to go down, these short sellers have to hold that position while still paying interest. Remember, if the price goes up, shorts are losing money. They had to borrow those shares at interest, and so the more the price goes up, the more those shorts are getting squeezed out of their position and having to buy back at higher prices, causing them to lose the money. And that's what basically a short squeeze is. So the next question is, when will a short squeeze occur? Actually, it can't be predicted because obviously no one really knows how high the price will go. It can occur several times a year sooner or later. Now, moving on to the next thing, some may wonder whether shorting is actually a legal thing to do. Some may see this as a kind of manipulation. So is the GameStop short squeeze legal? So if you can see the stock market as a game, it also has some rules. But in this matter, when Robinhood halted trading on GameStop, they changed the rules. Now the question is, what is Robinhood? Robinhood Markets is an American financial services company headquartered in Menlo Park, California, which is known for offering commission-free trades of stocks and exchange-traded funds via a mobile app. However, changing the rules after the money has been placed on the table, you can call that cheating. That's the reason why everyone is upset at Robinhood Markets. Changing the rules in the favor of the billionaire hedge funds is some kind of a crazy thing to do. Due to that, some people are already taking Robinhood Markets to court over their decision to shut down GameStop trading. Moving forward, to find out about the people's opinions, some might suggest that GameStop short squeeze was an easy way to make more money. What's your idea about that? Was it? Sure, it was an easy way as well as a risky way. Some Redditors made millions of dollars or 50 times of their investments in less than a week. But on the other hand, some people lost millions of dollars as well because they bought stocks far too late after the stock had already jumped in price. So as you can see, GameStop short squeeze was a highly risky way of making money. So when I said that some people made millions of dollars while others lost millions, now you might be wondering whether GameStop short squeeze had winners and losers. Yes, the GameStop short squeeze resulted in both winners and losers. Let's dig deep to get to know who were the winners and who were the losers. First of all, let's talk about the two main billionaire hedge funds in this story, Melvin Capital and Citron Research. These two were the companies that lost massively. They were billion-dollar funds, but according to the information we received, it is said that they had lost more than half of their funds in the short squeeze of GameStop. But on the other hand, many Redditors definitely won on average. Also, GameStop won, at least for a short period of time. They likely raised a huge amount of capital, which would have been impossible for many years without the shorting of the shares. And the other important point is that Robinhood lost, possibly forever, from the GameStop short squeeze. Their public image has been tarnished, perhaps irreparably. I hope you now have a complete and clear idea on what the GameStop short squeeze was. So what do you think about the short squeeze? And what do you think of the results of the short squeeze and the way it affected GameStop and other involved companies? And when do you think the next short squeeze will occur? Sooner or later? Let me know your thoughts in the comments section down below. Before leaving, don't forget to like, subscribe, and hit the bell button for notifications on our future content. With that being said, see you in the next one.